Have you ever wondered about the impact of massive industrial real estate transactions on our local economies and beyond? Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hemoin. Let's get right to it. In a significant development in the commercial real estate sector, a massive Amazon-occupied warehouse complex in South Richmond has recently changed hands for a whopping $97.5 million. This transaction was reported by Mike Platania and marks a considerable move by Dallas-based Stream Realty Partners, who acquired the properties earlier this month. The two warehouses located at 4701 to 4949 Commerce Road are occupied by Amazon and Brother International Corporation, a Japanese electronics manufacturer. These properties, totaling more than 900,000 square feet, were initially developed as spec space in the late 2010s by Panattoni and have since been leased to the current tenants. The previous owner, Maryland-based The Holla Companies, had purchased these assets in early 2020 for $79 million, indicating a substantial appreciation in value over a relatively short period. City records reveal that the most recent assessment of the properties was at a combined $87.3 million, highlighting the premium that Stream Realty Partners was willing to pay to secure these strategic assets. This acquisition follows Stream's recent purchase of a 135-acre industrially zoned parcel in Chesterfield for $3 million, although their exact plans for this land remain undisclosed. Stream Realty Partners, known for their comprehensive services in commercial real estate, including property management and development, appears to be making their first significant foray into the Richmond region with these acquisitions. Their portfolio already encompasses over 411 million square feet of assets under management, underscoring their substantial presence in the industry. While this transaction reflects the dynamic nature of the industrial real estate market in the United States, it also prompts us to consider the potential implications for similar markets closer to home, such as those in Kitchener-Waterloo, London, and Cambridge, Ontario. These regions could potentially see similar interest and investment from larger firms looking to expand their industrial footprints. In Manassas, Virginia, SRS Real Estate Partners has successfully arranged a $6.8 million sale-leaseback of a retail property, marking a significant transaction in the area's commercial real estate market. This property, occupied by the Learning Experience, an early childhood education and childcare center, sits in a prime retail corridor and is on a triple net lease basis. Built in 2023, the two-story, 11,150 square foot facility is run by one of the Learning Experience's largest franchisees. Located at 10,219 Dumfries Road, the property is surrounded by major retailers such as Walmart Supercenter, Harris Teeter, LA Fitness, Chick-fil-A, Raising Cane's, and Wawa Convenience Store. The strategic location and the stable tenancy make it an attractive investment for the 1031 exchange buyer, a private investor based in Northern Virginia. This transaction was facilitated by Andrew Fallon and Philip Welda Jr. From SRS Washington, D.C., Capital Markets Team, representing the seller, Ganges Manassas, LLC. Interestingly, SRS Real Estate Partners has also listed another site occupied by the Learning Experience in Northern Virginia for $7.6 million, indicating a strong demand for properties with stable, long-term tenants in strategic locations. This trend could offer insights into similar opportunities in Canadian markets such as Kitchener-Waterloo, London, and Cambridge, Ontario, where retail corridors are also seeing significant interest from investors. In the United States, the sale-leaseback model continues to gain traction as it allows property owners to unlock capital while retaining operational control over their premises. This approach is particularly beneficial in the current economic climate, providing liquidity and financial flexibility. Canadian investors can look to this model as a viable option for maximizing the value of their real estate assets while maintaining business operations. In a notable move within the tech office leasing sector, StubHub has secured a lease for almost 56,000 square feet at 7,000 Central Park in Atlanta. This significant lease marks the second largest office lease for an out-of-town tech company in the city since 2021, according to CBRE. The New York City-based ticket reselling giant has brought hundreds of workers to the Central Perimeter area, signaling a potential rebound in office leasing within Atlanta's tech industry. The lease at the 18-story tower, located just inside Sandy Springs city limits, represents a shift in momentum for out-of-town tech companies, which have been slow to return to traditional office spaces since the pandemic. According to Christian Devlin, Senior Vice President at CBRE, StubHub's expansion to Atlanta demonstrates a renewed interest from tech firms in establishing physical office spaces. Although office leasing has been on the rise in recent months, much of the activity has been driven by companies with existing Atlanta operations renewing or swapping local space. Since the COVID-19 crisis, tech companies have been hesitant to return to the office, with some remaining fully remote or transitioning to hybrid work models. However, the tech sector accounted for just 7% of overall office leasing activity in Atlanta in the first 3 quarters of 2024, compared to cities like Austin, Texas, where tech made up nearly 60% of new office leases during the same period. Tech companies are now designing new offices to accommodate hybrid work models and boost employee productivity. For instance, software company Sage recently opened a new North American headquarters at Ponce City Market, featuring amenities such as large cafes with baristas and collaboration areas. This trend reflects a broader shift in the industry towards creating attractive workspaces that encourage employees to return to the office. StubHub, which has more than 200 employees in Atlanta, began relocating workers to the city in July 2024. This move aimed to enhance its customer support operations for European clients by moving its hub from Utah to Atlanta. The company initially occupied co-working space in Central Perimeter before signing the lease at 7000 Central Park in February of this year. StubHub's office now includes roles in customer service, tech, and operations, with plans to expand further. The increased leasing activity in Central Perimeter is seen as a positive development for the Atlanta office market, particularly as major road projects in the area are completed. Industry experts note that this uptick is attracting larger employers seeking to tap into the talent pool across Metro Atlanta. The momentum is also supported by office conversions, which help reduce obsolete space in the market, contributing to a more dynamic office environment. Store closures can often seem like a negative sign for local economies, but they also present new opportunities for businesses looking to expand. In the Sacramento area, recent closures of Joann and Party City stores have created significant vacancies, but these spaces are quickly being targeted by expanding companies. This trend aligns with the broader retail landscape, where businesses are keen to occupy existing spaces rather than invest in new constructions. It's a pattern also observed in Canadian cities like Kitchener-Waterloo, London, and Cambridge, Ontario, where the demand for retail space remains strong despite economic fluctuations. In the Sacramento region, Party City closed 6 stores, while Joann Inc. shut down 6 locations as well. These closures, along with those of other major retailers like Big Lots and 99-cents only stores, have left large retail spaces available. However, the situation is not as dire as it might appear. Retail experts note that the demand for these spaces is robust, and many are being quickly filled by expanding discounters and entertainment centers. Retail vacancies in prime locations, such as those left by Joann and Party City, are particularly attractive to potential tenants. The lack of new retail construction means that businesses looking to expand are focusing on these existing spaces. In Ontario, similar trends are seen as businesses seek to capitalize on available retail locations in high-traffic areas, mirroring the activity in the Sacramento market. In Sacramento, companies like Burlington and Sierra, part of the TJX company's portfolio, are moving into these vacant spaces. Burlington is set to open a new store in a former Big Lots location, while Sierra plans to occupy spaces previously held by PetSmart and Office Max. This kind of activity is echoed in Canadian markets, where retailers are also expanding into existing spaces rather than pursuing new developments. Discounters such as Five Below and Dollar Tree are also stepping in to fill the void left by closures in the Sacramento area. These retailers have claimed lease rights for several former Party City locations. This trend could serve as a model for Canadian retailers who are looking to expand by taking advantage of existing retail vacancies. The appeal of these big-box retail spaces lies in their strategic locations and the existing infrastructure, which can be quickly adapted to suit new tenants. In Ontario, as in Sacramento, expanding businesses are leveraging these opportunities to establish a strong market presence without the need for new construction. It's a strategy that allows for rapid expansion and a quicker return on investment. While the retail landscape is adapting to these changes, there are considerations that could impact future leasing activity. Economic uncertainties remain a factor, and businesses must weigh the potential risks against the opportunities offered by these vacant spaces. However, the current trend suggests that both in the United States and Canada, the demand for strategically located retail spaces remains strong, providing a positive outlook for future growth. In a notable expansion move, a Denver-based private equity firm is making headlines as it sets its sights on the Phoenix market, with a particular focus on distressed multifamily assets. This strategic shift is part of a broader trend where firms are looking to capitalize on distressed properties to maximize returns and revitalize communities. The firm, which has not been named in the article, is looking to leverage the current market conditions in Phoenix, where there is a growing demand for affordable housing and a significant inventory of distressed properties. This move aligns with the firm's strategy to invest in undervalued assets, upgrade them, and subsequently generate higher rental yields. This trend is not isolated to Phoenix alone. In Ontario, regions such as Kitchener-Waterloo, London, and Cambridge are also witnessing increased interest from investors seeking similar distressed opportunities in the multifamily sector. These areas are seeing a rise in demand for affordable housing, driven by population growth and urbanization, making them attractive targets for investment. The cross-border relevance of this trend is evident as Canadian investors are increasingly looking to the United States for opportunities in the multifamily real estate market. The economic conditions, coupled with favorable exchange rates, make American markets like Phoenix appealing for Canadian capital. As the landscape of multifamily investments continues to evolve, it's important for investors to remain informed about market trends and opportunities. The focus on distressed assets provides a unique chance to contribute to community development while achieving financial returns. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoon. See you on the next one.